For over a century, the traditional banking model has relied on a very simple premise to generate unimaginable wealth. They take your deposits, lend them out for massive profits, and generously pay you practically zero interest in return. In fact, just 4 US banks generate over $262 billion in pure interest revenue last year by paying you a pathetic 0.4%, while shamelessly earning nearly 4% on those exact same funds. But the explosive growth of fully reserved, high-yield stablecoins has created an existential threat to that monopoly. The mainstream financial media say that the government's latest crypto regulation is simply about protecting consumers from systemic risk. But buried deep inside a stalled Senate bill is a highly coordinated, multi-million-dollar lobbying effort designed to legally prohibit you from earning a fair yield on your digital dollars. My name is Lewis, and you're watching The Coin Bureau. We could be witnessing a desperate protectionist tariff by the traditional banking cartel. Or perhaps the government is about to kill the single best use case for decentralized finance. Or maybe this liquidity simply flees offshore to permissionless protocols. Before we find the answer, though, let's look at the legislative catalyst that started this entire war. On July 18, 2025, President Trump signed the Genius Act into law. It was universally praised as the first comprehensive federal framework for digital assets in the United States. The law mandated that permitted stablecoin issuers must back their tokens one-to-one with high-quality liquid assets. This includes short-term treasury bills, reverse purchase agreements, and actual bank deposits. But to get this bill passed, lawmakers included a massive concession to the traditional financial system. Section 4 of the Genius Act strictly prohibited stablecoin issuers from paying any form of interest or yield directly to token holders. If you issue the stablecoin, you keep the yield generated by the reserves and holders get none of it. But the lawmakers left a massive loophole wide open. The law did not explicitly prohibit third-party platforms, crypto exchanges, or decentralized protocols from offering indirect yield or rewards to their users. And that is exactly what companies like Coinbase began doing, passing the underlying treasury yields back to retail investors. Now, the banks are panicking over this loophole because of how they actually make their money. For over a century, the traditional banking model has relied on a system called fractional reserve banking. When you deposit your money into a checking account, the bank doesn't just lock it in a vault. They keep a tiny fraction in reserve and lend the rest out for massive profits. The difference between the high interest that they charge borrowers and the microscopic interest that they pay you is called the net interest margin. And right now, that margin is the lifeblood of the legacy financial system. In 2025, the 4 largest US banks generated a combined $262.8 billion in net interest income. JP Morgan Chase alone pulled in over $95 billion. They do this by paying depositors a national average of roughly 0.4%. Meanwhile, they take your deposits and park them at the Federal Reserve or in short-term T-bills, yielding around 3.7%. That is a spread of over 330 basis points that should arguably belong to you, but is being captured by Wall Street. Stablecoins completely break this model. Because stablecoins operate on a 100% reserve model, they don't engage in risky fractional lending. When a third-party DeFi protocol or exchange offers you 4 to 7% APY on your USDC, they're simply passing the true market yield back to the actual owner of the capital. It is a technologically superior, fully reserved alternative to legacy banking. And the banking cartel knows that if retail investors are allowed to earn fair yield on digital dollars, well, their deposit monopoly will completely collapse. And speaking of protecting your wealth from these regulatory traps before they wipe out your portfolio, this is exactly why you need the Coin Bureau Telegram channel in your life. That is where we share the latest breaking news, provide deep dive alpha, and give you the most important market updates, all pinged directly to your device so that you don't miss a thing. Whether it's a hidden clause in a new Senate bill or massive on-chain whale movements, our members see it first. So sign up today using the link down below or by scanning the QR code on the screen. Now, back to the legislative war. The banks are not going down without a fight, and at this point, the Digital Asset Market Clarity Act enters the picture. This is a massive piece of crypto market structure legislation that passed the House in July of 2025. But right now, it's completely stalled in the Senate. And the reason it is stalled is because the American Bankers Association is holding it hostage. The banking lobby has aggressively pushed for a specific provision in the Senate's draft of the bill, widely debated as Section 404. This provision would completely close the Genius Act loophole. It prohibits digital asset service providers from offering any form of interest or yield solely in connection with the holding of a payment stablecoin. If passed, it would make it illegal for any regulated U.S. entity to pass that treasury yield back to you. Violations carry a proposed penalty of $500,000 per offense per day. The banks are not even hiding their true motives anymore. In a highly coordinated letter campaign, the Independent Community Bankers of America explicitly warned the Senate that stablecoin yield would cause a structural shock to credit markets. They claim that up to $6.6 trillion in deposits could flee the traditional banking system. They are arguing that because their business model relies on paying you next to nothing, it should be illegal for anyone else to pay you something. It is regulatory capture in its purest form. And on March 5th, 2026, the American Bankers Association formally rejected a White House compromise that would have allowed limited transaction-based stablecoin rewards. They want a total ban. But here's where the story gets genuinely complicated for the banking cartel. Because there is a massive structural flaw in their plan. If they successfully pass Section 404 and ban yield on centralized US platforms, that capital is not all going to return to a traditional savings account. Much of it will simply migrate to permissionless, decentralized finance protocols. And the federal courts have already confirmed that the government cannot stop this. On March 2nd, 2026, a federal judge in New York handed down a landmark ruling dismissing a class action lawsuit against Uniswap. Judge Catherine Polk ruled that it defines logic to hold open source developers liable for how autonomous smart contracts are used by third parties. Furthermore, in late 2024, the Fifth Circuit Court of Appeals ruled that immutable smart contracts cannot be sanctioned as property by the US Treasury. Because, well, you cannot issue a cease and desist letter to autonomous code. Right now, decentralized lending protocols like Aave are offering between 4 and 7% APY on USDC. Offshore exchanges like Binance are offering upwards of 10% on USDT. If the US government bans yield on regulated offshore platforms, a lot of liquidity will simply flow to the path of least resistance. So, the intense lobbying around the Clarity Act is not about protecting consumers or preserving the stability of the US economy. It is a desperate, highly coordinated attempt by the traditional banking sector to prevent you from accessing the risk-free rate that your capital actually generates. Stablecoins have exposed the massive arbitrage at the heart of fractional reserve banking. Wall Street knows that they cannot compete with a 100% reserved digital dollar that pays a 4% yield. So, instead of competing, they are spending tens of millions of dollars to legally ban the competition. The question isn't whether the banks will try to pass this protectionist tariff. The data proves that they already are. The real challenge we face now is whether the decentralized infrastructure can scale fast enough to absorb the trillions of dollars seeking a fair, permissionless yield before the regulatory doors lock from the outside. But what do you think? Is banning stablecoin yield necessary to protect the traditional credit system? Or is it a catastrophic overreach by the banking cartel? Let me know your thoughts in the comments below. And if you want to understand how Wall Street is building KYC compliance directly into smart contracts, well, you could check out our video on that right over here. And if you want to dive deeper into how institutional ETF flows are impacting Bitcoin's base layer, well, you could check our video on that right over here. Thank you all so much for watching, and I'll see you again very soon. This is Lewis, signing off.